Hey everyone, me Kevin here. Here's a breakdown on everything the Federal Reserve just said, including Federal Reserve Chairman Jerome Powell's response to the question about whether or not we're heading for a double-dip recession. The Fed is keeping rates at 0 to 0.25%, which is a rock bottom essentially. If the Fed also stated that they want to keep inflation, quote, well anchored at 2%, a phrase they haven't used before, or at least recently, and they want to purposefully make sure that inflation runs over 2%. We have heard that before. To accomplish this, they're going to keep interest rates at 0 until the following three things happen, which is the first time we've gotten this specific three-thing outline here. Number one, maximum unemployment. They want to see maximum unemployment in the economy. This means it's unlikely we're going to see interest rates go up until the unemployment rate is, say, between 4 to 4.5%. Number two, they want inflation at 2% and people's inflation expectations at 2% going forward. This was an interesting shift. Not only do they want to see inflation at 2%, but they want people's expectations to be that, yeah, inflation's going to be 2% for the long run, which right now everybody's like, yeah, okay, whatever, Jerome, you try to get inflation up to 2%. We all know it's going to be next to nothing. So nobody believes them. And they've actually changed their verbiage to make that more clear that this is their goal. And basically they're saying, we'll just keep rates low longer then. Fine. How about now? You expect inflation now? Still no, but whatever. Right? And then number three, he mentioned that he actually wants inflation over 2% for a good amount of time. I'm guessing that means 6 to 12 months. So we're going to see a period where inflation is over 2% for a while. Before anything changes with interest rates. So this is good for planning purposes. Now, the Fed also plans to increase asset purchases over the next months. That's going to provide liquidity to the treasuries market and mortgage-backed security market, which is basically just a way of ensuring that if companies need to raise cash, there's somebody there to buy their treasury bonds that are being sold by companies that they hold, or it makes sure that there's enough liquidity, and there's enough liquidity in the mortgage market so that loans keep flowing to the mortgage market. Then the Fed discussed how important it is to help individuals and businesses, and then we get into stimulus and the double dip. He cited two main concerns. Number one, COVID expanding potentially exponentially in Europe and in the United States. And number two, providing relief to millions to tens of millions of people who have lost their job. He said the CARES Act was crucial in helping our recovery, and stimulus is needed to help both COVID and people's savings, which are currently getting depleted. And this is coming, of course, as recent data shows that the personal savings rate has been declining as stimulus has faded away. The Fed does say they're all in on their end and they're on standby to do more as needed. Chairman Powell wanted to make sure that he does everything possible to basically reduce the length of the recession caused by the pandemic. He says this is a very different kind of recession, where ordinarily when you have a recession, demand stops, they drop rates, demand comes back. But in this case, we just have a bunch of people who all of a sudden lost their jobs because of a pandemic. So it's a very unique kind of recession. He does say as well that by providing as much monetary support as possible, they're trying to limit bankruptcies both for the individual and for businesses, but this is something that generally the Congress should be doing with stimulus and fiscal support. On stimulus, he strongly believes that we will likely need more stimulus support and hinted that he will do whatever he can. But again, this is trickle down, right? When the Fed works, what did I say they provide liquidity to? Treasuries, which provide liquidity to businesses, and mortgage-backed securities, which provide liquidities to mortgages. The people kind of get helped after that. So it's kind of like you go buy a house, a fixer-upper, and you fix it up. You're employing people, you're helping people by doing that, but it's a secondary way of doing it. The Congress can come in and just provide a check to the person you would otherwise hire, right? So it's a totally different style of supporting the markets. Now, even though Jerome Powell says that the people who need it most are women, minorities, and those making under $40,000 per year, he did acknowledge that they're the ones who get helped last by the Federal Reserve, especially when you lose your job. He was also concerned that when you lose your job, your skills atrophy or get worse, and you actually become less employable, which is really bad for the economy. When asked what happens if there is no stimulus and what about a double-dip recession as a possibility, the Federal Reserve Chairman Jerome Powell stated it looks like the, quote, severe tail risks that we had started to plan for, quote, have subsided. AKA, in English, there's less risk of a double-dip recession now than what the risks were in March and April. Instead, Jerome Powell now says the biggest danger is COVID. He cited cases in Europe, which Germany just hit records today, and France just minutes ago reported 58,000 cases in one day. France is a fraction of the size of the United States population, around 1/5 to 1/6 of our size, but has almost as many cases as we had just 10 days ago. In other words, now the market is functioning normally, the risks of a double dip recession are low, and right now the biggest issue is trying to shorten the pain that people are feeling without stimulus relief, and that's where Congress should step in. Yet now we hear that if Donald Trump loses, there's the potential he might not be interested in doing a stimulus package because he thinks that should be a Joe Biden plan, which is not very good. Coupling that not very good news, it's quite possible that the Fed looks and goes, okay, well, crap. Here comes COVID to shut down more of our economy, cause more job losses, and what are we going to do to try to help everybody? Prop up the stock market and the real estate market, which is great, again, if you're in stocks and real estate. But if you're not, it sucks right now. That's the update from the Fed. It's not the most generous update that I'd like to be giving. I'd like to be able to make a video going approved stimulus checks are coming out, but right now those would just be clickbait titles. So thank you so much for watching this video. This is the update from the Federal Reserve. We'll stay tuned with everything that's developing. If you like this kind of content, consider subscribing, consider sharing it. And folks, we'll see you next time.